SuperAI. Everybody wants to know what's going on in AI. This has been the event to figure it out. You get to speak to the smartest people like you trying to figure this out, but also the people on stage. They're the experts. So we get all of that, all in one place, in Singapore. What more can you ask? It's a brilliant, brilliant event, and you'll come away with lots of new ideas and a better understanding of this incredible exponential world.
Hey everyone, sorry to interrupt, but this is the cheesy podcast bit that gets on everyone's nerves, but it's really important to me. Please, if you can like the channel and also subscribe, it helps me a lot to get the best guests in the world for you guys. So click like and subscribe. Appreciate it. Thanks. Hi, I'm Raoul, and welcome to my show, The Journeyman, where I journey to that nexus of understanding between macro, crypto, and the exponential age of technology. Now, at heart, I'm a macro guy. I've lived macro for 35 years. It's how I see the world. It's what I do. It's how I build my frameworks of understanding. So it's always a pleasure to sit down with somebody to talk macro, to understand what's going on. And there's a shit ton going on right now, whether it's tariffs, whether it's economic slowdowns, whether it's fear over bond markets, everything is happening. So there's no better person to sit down with than a good friend of mine, Andreas Steno. Andreas and I have known each other for a long time. He's been a long-term guest on Real Vision and then joined Real Vision Pro as part of the product with myself and Julian Battel. So we bring our GMI firepower and he brings his Steno research firepower, and we come together to try and help people in their journey of understanding. Now, what's great about Andreas is he and I share similar ways of looking at the world, but he comes at it somewhat differently. He uses more geopolitics. He's also shorter term in his time horizons, but within the same framework of understanding that I have. So it dovetails really well. Sometimes we'll have differences, and sometimes we'll come to agreements on where the opportunities lie. So in a time like this, when there's a lot going on, it's a great conversation to have. And I think you're really going to enjoy hearing what Andreas has to say. So let's dig in. Join me, Raoul, as I go on a journey of discovery through the macro, crypto, and exponential age landscapes. In The Journeyman, I talk to the smartest people in the world so we can all become smarter together. Andreas, finally, I get you on The Journeyman.
Yeah, it's great. We've been planning this for a while, Raoul, but we're finally here.
I know. So, I mean, for those of you who don't know, obviously from the intro, I've mentioned it, that Andreas is part of Real Vision Pro Macro with me, where we try and kind of navigate the landscape of what's doing. And we'll cover a bunch of that today. But really, Andreas, I want to go back in time and hear your journey, how you got to where you are today.
Yeah. So, like at least professionally, I'm born and raised in a Northern European bank called Nordea. And those of you who are familiar with that bank will know that it's a large bank mainly in Scandinavia, but also in eastern parts of Europe. And I grew up at the trading floor there, trading everything from foreign exchange.
So that was out of university, you joined Nordea?
Yeah. Great bank, actually. And one of the few banks that actually allows for some freedom of speech for analysts and traders and so on and so forth. So it was actually a really good professional environment to grow up in. I had a couple of great mentors there. One of them told me very, very early on that if I could not show my macro thesis in a chart, then it wasn't true, that thesis. And I think that's a really, really good point, and something that I've always been very aware of in my professional life, that you need to be able to showcase your thesis visually, and that was something I learned during my time at the trading desk in Nordea.
And what were you trading? Equities or
mostly foreign exchange, actually? Okay. And I guess the reason why I ended up in FX was that I kind of liked that interplay between various regions around the world, politics, how decisions from central banks impact markets and all of that. So I actually think it's a really good macro playground.
And it used to be much more macro currencies than it was now. Now, a lot of them don't move versus each other. But it's macro.
Yeah, and foreign exchange seems so boring relative to what's going on elsewhere, right? But you're absolutely right. When I started, it was actually right after Lehman at the FX desk. It was a pretty interesting time for foreign exchange, especially during that 2010, 2011 time span where we had the whole discussion on whether the euro would survive and all that. Really, really interesting times on an FX desk. So I learned a lot from that, and it basically led me to being a macro strategist after spending time in foreign exchange, because I figured out that macro was really what interested me by the end of the day. And I wanted to venture into something that was much more cross-asset. And at some point, during that time span at Nordea, I got in touch with you, Raoul, and I remember that day because, Nordea allowed me to just be out there. So I was on Twitter, Instagram, you name it. And I was one of the very first bank analysts to be on SoMe. Especially on Twitter. It wasn't really populated by bank analysts back then.
No.
It still really isn't, right?
No, it's not, because most people aren't allowed to talk publicly.
Yeah. But for some reason, they allowed me to do so, and I ended up with a couple of 100K followers pretty swiftly thereafter for some reason, probably because the content was okay. And, all of a sudden, Nordea was like, okay, that was probably a pretty good idea to bring you on Twitter, right? Because hedge funds and institutions around the globe started reading the strategy and research from a little Northern European bank there. And for some reason, it ended up on your table as well, Raoul. Here we are, right? So it's been a great journey, and I'm very thankful that I met you.
Hi, Raoul here. Listen, I think we've got until 2030 before the economic singularity arrives. Now, it might not be the exact date, but it's around then. So we have about 6 years to figure out how to unfuck our future. I've put together a report to help you called Prepare for 2030. It's going to help you take the first steps in that journey to make sure you're secure past 2030. So just click on the link below and start your journey now.
So talk to me, when you started as a macro strategist, what framework did you build? How did you think the world worked in terms of, were you looking at ISM and cyclicality? Were you looking at more traditional economic flows? How are you looking at things, and how has that evolved as time went on?
So I essentially started my trading career at the trading floor right after Lehman, right? So I'm born and raised in a world of QE. I have no clue how markets work without QE. I'm not really I don't really have a background where I can talk about how markets worked before central banks got involved to the extent that they are today. So I think the first task,
which is probably a plus point, I would say, because you're not scarred by how things should be, but you're dealing with how they are.
Yeah. And one of the things that led me to where I am through that 2010 to 2020 time span was that I kept saying that interest rates would be artificially suppressed by central banks, because that was the only thing I knew. And it proved to be a right point. And therefore, the framework I started building was very centered around central bank balance sheets and how they impacted bond yields. That was essentially my first thesis. And I remember the very first interview I did with one of your colleagues at Real Vision back in maybe 2014, something like that, was about how QE impacted bond yields in the opposite way of what the consensus was. Because every time
I remember this, you were saying bond yields go up every time there's QE, and everyone was thinking they're buying bonds and bond yields should go down. I remember seeing that going, he's right.
Yeah, and it actually proved to be right for quite a few years in a row. I've struggled with that thesis for the past couple of years. And, you and I have talked about bond yields over and over on shows, and we haven't really gotten it right a lot of times.
I can't trade bonds anymore. I used to be really good at bonds. I just cannot get them right.
No, it seems like this thesis that central bank balance sheets impact bond yields in the way you just described is not really working as it intended anymore. So we need to come up with a new thesis on that. But that was my first thesis, and it played out very beautifully. And then I moved on from there to try and assess, okay, how is this central bank balance sheet regime going to impact across assets? And that was essentially also what ultimately led me to to consider crypto as an asset class. Too late compared to others, but the whole notion that central banks would get involved to the extent that we've seen over the past 15 years or so was something that I was just thrown right into that mix. I started trading exactly when this became a thing. So it was my journey to become a trader and become an analyst in that environment. And that's why I've always focused on that. And I don't think anything else matters for you.
And when did you start Steno Research?
After the pandemic. I actually spent maybe 10, 11 years at Nordea, ended up as like the global head of the strategy and research team. But ultimately, during the pandemic, I got annoyed with all of the rules that were implemented about, my ability to speak publicly and all of that. So Nordea basically ended up more or less as the rest of the pack in the investment bank space, trying to limit strategists from tweeting stuff and so on and so forth. And I've always been a contrarian thinker, and when you start seeing rules like that being implemented, it's impossible it's just not possible to be a contrarian in such a setup, right? So it led me to open my own research shop, and I've never really looked back since. It's been the right move. And I enjoy being able to speak my mind, because, the worst thing, and I guess you've been in a ton of these meetings as well, Raoul, is to listen to a strategist constrained by some sort of political landscape by his employer, right? His or her employer. That's not value adding to any extent, right? You need to be able to say exactly what you think.
Yeah, that's just marketing. It's not a transfer of knowledge.
No. Exactly. And it's kind of the same, no matter whether you work at Goldman Sachs or JP Morgan or whatever. It's very difficult to actually state your opinion. You're influenced by a lot of political factors internally, and that's something you have to deal with when you work at an investment bank.
So one of the things you talked about is, you were very early to understand, because you knew no different, that the central banks were large players in how economies and markets work. Did you realize early on that governments were in cahoots with central banks, and that they weren't now separate entities, even though they claimed they were? They weren't, because, you've been a pioneer of the flows of this kind of stuff as well. When did you start to realize they were actually working all together in concert with each other?
To be honest, Raoul, I think it became crystal clear to me in 2020, not before.
I agree.
We had a bill to pay in one way or the other during the pandemic. Everyone had to get a bailout, and it was impossible to fund that without central banks ultimately funding the issuance of all of the T-bills and sovereign bonds issued worldwide. And it felt exceptionally coordinated, and it probably was coordinated between Treasuries and central banks, what happened in March, April 2020.
And globally coordinated as well, amongst all of them.
Yes.
Because we kind of thought that in 2008, but we didn't really see evidence maybe in 2012 with Draghi. But then we weren't sure. But yeah, this was like, oh, they're all the same thing.
Yeah, and then Silicon Valley Bank happened, right? It was on a Friday afternoon. And remember this rule of thumb, right? A bank will always go bankrupt on a Friday afternoon. So you have 48 hours to fix stuff before it reopens. And between Friday afternoon and Monday morning, the US Treasury and the Federal Reserve fixed it. And they coordinated it once again, right? Liquidity injections, and the Treasury basically backstop banks at the same time. So the last two major crisis events, it's not even been, it's been transparent that they work together now. It's actually not something that they're hiding anymore, which is something new. I think they worked together back in 2008 as well. It was right about when I started my trading career, but it wasn't transparent that they did so. But it's been pretty transparent in 2020 and in 2023 with Silicon Valley Bank. So they're not even trying to hide it anymore. And Janet Yellen's, one of her final remarks as the Treasury Secretary was this remark around the ability to afford the debt load of the US Treasury. And she basically told the Federal Reserve that we cannot have interest rates at this level for a prolonged period, because then we're not able to finance this. And it wasn't really even hidden. It was in kind of in officialese terms, but if you understand officialese, it wasn't it. It was a clear hint to the Federal Reserve that they would have to bring interest rates lower, which they did during that autumn space, right? So it's not hidden anymore. Well, it's out there, and it's something we'll have to deal with.
So now we've got Scott Bessent, who is macro guy, so he understands the game. Interest rates are still way above GDP growth or whatever. It's, so interest payments keep escalating. What are they going to do here? How do they get out of this mess of just, because they're going to have to debase currency a lot to pay for all these instruments. What's your kind of framework of where we are and how this is going to solve itself in this cycle, not in the long term? We'll talk about the long term in a bit.
Yeah. So, we're approaching a massive refinancing cycle right now. And that's something you need to consider when you assess central bank balance sheets, bond yields, and the impact across assets, because we're not going to make it through the next 24, 48 months without lower bond yields. I essentially rule that out. And if we get a market that is not willing to play ball, the central bank will essentially have to solve it. So how do we get to a point where the central bank needs to step in? I think they're kind of engineering that scenario right now in front of us. We basically need a market that is sufficiently weak for the Federal Reserve to be able to use the excuse that financial stability is threatened. Because with inflation running a little bit above target still, even though I think it's declining here, and with a debt load that is as fierce as it is, they'll have to be able to use this financial stability excuse to come up with some sort of way of solving this.
So you're suggesting they have to break something?
Yeah. At least I think it's a valid thesis here, because otherwise I think they would have stopped a few weeks ago. That's point number one. Point number two is that if the central bank is a little bit scared of restarting QE for a list of reasons, whether they're political or whether they're related to the inflation pressure, they could find alternative ways of asking the private system to buy the bonds for them. I've floated the idea that This
is why I've been using total global liquidity as almost a better measure, because they're using the private sector.
Yes. And that's a new thing, because, a couple of years back during the pandemic, it wasn't needed, but it's needed now. So they have a couple of options here. One of them is to basically, via regulation, force banks to hold more US Treasuries in their liquid assets. And, if a bank is forced to do so, it happens, right? They cannot do anything about it if they're forced to do so via legislation. And I think that's a very simple way of solving this. So, I've talked to a lot of guys telling me that the Fed is cornered here because inflation is too high for them to restart these bond backing schemes. And, well, my response to that is basically, well, then they'll force someone else to fix it. And they could easily do that, even if, let's assume that the Federal Reserve will kind of turn a little bit political here against everything that Trump is doing. Let's just assume that. The Trump administration could itself impose these rules on banks, right, via all sorts of tricks they have up their sleeve. So I don't think that will, avoid some sort of situation where the private sector will have to accept being used as a funding vehicle here. And there are many ways of solving this.
The other way is
the Trump administration could do it itself, right? Yeah.
there's also the pension system. I mean, Europe
Yes.
did this decades ago, which was force the pension system to hold more bonds. There's also the insurance sector. You can force them to hold more bonds. There's infinite bond buyers. People are like, well, if China don't buy bonds, it's the end of the bond market. I'm like, no, there's trillions of dollars of savings sloshing around between the insurance companies and the pension plans, and then the banks. That liquidity alone is enough.
Yeah, all agreed. And, Raul, given that we've been through, a couple of months of extreme market turbulence, I get this question every single time. Has something structurally changed? Is this more of a structural bear market? Will geopolitics play a role over the next 5-10 years, sort of changing the whole structural narrative around technology, crypto, and all of that? And the simple answer is no every single time, because everyone in this administration, everyone in Congress, they're all incentivized to bail out this system once again. And especially the generation you belong to is incredibly indebted in housing, etc. And they all have an incentive to solve this every time the issue arises, right? So I don't see...
And the baby boomers do as well, which is most of the government, because it's their pension plan.
Yes. So ultimately, you need to look at the incentive structure of those taking decisions, and they're all incentivized to reset the system once again via debasement. They're all incentivized to do so.
And so my view on this is, and people don't realize this because you say it all the time, it's going to be 1929 over again. It's going to be 2008 all again. It's going to be, I'm like, they have taken the left tail risk out of markets. And so if that is the case, then the risk reward is so skewed that I think it's the greatest macro risk taking opportunity of all time, because they've taken the big risk off the table, which is the black swan. Because you and I know the second anything bad happens, the second collateral gets affected, they print money.
Yeah. Yeah. And just look at it this way, Raoul. From a technical standpoint, we've even seen that the administration has mulled the idea of backstopping the so-called basis trade of hedge funds.
That's right.
And that's it's a very technical thing, but what it basically means is that they want these hedge funds to take part in funding the deficit as well. They want to ensure that liquidity conditions remain stable. And all of the hedge funds are obviously very levered, and they want stable liquidity conditions to be able to fund the treasury via these basis trades, etc. So my point is just everyone with access to this administration, everyone within the administration, they're all incentivized to do this reset once needed.
And then on top of it, at government level, we also have the fact that they're playing with the financial levers using the Treasury General Account now as well. And it's not, it used to be in the past a nothing burger. And now it's being used to either juice what the central bank is doing or offset what the central bank is doing. So the government is now playing the game of money as well.
Yeah, it is. And, the Federal Reserve also clearly caved into this already a few meetings ago. They cited this whole development around the Treasury General Account as a reason to end the quantitative tightening. And I know that they've not ended it, but they've ended it for all practical purposes already, right? We're talking minuscule numbers now in the bigger scheme of things. So again, this is a clear sign that the US Treasury and the Federal Reserve, they're cooperating around this. And we kind of know what the conclusion is ultimately of all of this, given that the cooperation is not hidden anymore and they're incentivized to do the same thing.
So what does that mean for asset prices in the market on a longer term basis and, and where we are in the cycle? I mean, because now we've got these super players that have taken the left tail risk off and debasing currency. What does that mean for investors? And what does it mean for people? So people watching this, I don't quite know what you're talking about. What does it mean to you?
So first of all, Raoul, if we look at the central bank balance sheet in the context of everything that's ongoing with tariffs, NATO, the negotiations with China, etc., let's just address a question that I get a lot around that, because we obviously know that China, Japan, etc., they hold a lot of US treasuries. And it's a theme that is always brought up when we get these geopolitical tensions back and forth between the countries. So
assuming yesterday the bond market moves one day and everyone goes, China's dumping treasuries. I mean, all the time.
Yes. I don't buy that, by the way, but let's just assume that China sells US treasuries and Japan will decide to do the same as a consequence of what's ongoing on tariffs. I don't buy it, but let's just assume that. I think the worst, quote unquote, worst case scenario would be that the Federal Reserve will have to step in with some sort of light yield curve control in such an environment, which ultimately leads to the same conclusion that the currency will be debased because they'll have to print dollars to avoid escalating tensions in bond space. So the layman terms conclusion of all of this is that the dollar that you hold at a bank deposit will be worth less over time as a consequence of the central bank bailing out the bond market. And I don't hold high hopes on behalf of the Doge project. I think it's almost impossible to bring the deficit down. Ideologically, I think
it might
give it a shot.
Some of the increase that's coming from the interest payments, but it's just slowing down the rate. It's not reducing it.
Yeah, and as we speak, it also kind of feels like Elon has thrown in the towel on that job to some extent. Even though you'll have to praise him for his efforts, but it's an impossible task to really change the trajectory of the deficit, in my opinion. So the point here is that we'll have to do something to avoid a scenario where interest rate payments just grow and grow and grow and grow as a part of the budget. And take a look at the Japanese case over the past 2-3 decades to get some sort of feeling of where we're headed, because Japan ultimately had to protect the yield curve. Otherwise, the budget would simply not, it would not be sustainable without it. And now we're seeing, small signs of higher bond yields in Japan. And as soon as that happens, it doesn't really work, right? The central bank always have to, either rhetorically or via market interventions, step in every time something happens in bond yields in Japan. And I ultimately think that we're moving towards, over the next decade or so, some sort of similar scenario in the US. And I think there's a lot of literature proving this. As soon as you're above, say, 100 to 120% of debt to GDP, it's the point of no return. It's very, very difficult to get back.
And because my view on that is, at a very simple level, GDP growth, annual GDP growth, is the income or revenues in the system that services the debt. Now, if the public sector is 100% of GDP in debt, and let's say interest rates are 4%, and let's say for easy maths, interest rates are at 2%, and the economy is growing at 2%, that's basically all of the economic revenue pays government. But the private sector's 130% of GDP in debt on top of it, or more, and in which case there's just not enough revenue to service the debt. That's kind of what I got to with this everything code thesis. And therefore, there has to be a mega player in that absorbs all of one side of the balance sheet, which is the government, which has to be done by the central bank and the government.
Yeah. And, if we look 5, 10, 15 years ahead, Raoul, as an economist, I think what's upcoming here is an incredibly interesting time for productivity. And, you and I just chatted earlier today around how solid an analysis of the current macro backdrop you can get from ChatGPT. It basically spits out the conclusions.
It's now giving like probabilistic understandings, joining the dots, which I didn't think it would get to, the kind of macro dots. I mean, I showed you that ChatGPT thing. It's like, oh shit, okay, this is getting really smart.
Yeah, and in a few years, you and I will just have to entertain people. We cannot really add any value relative
It'll
to
just be drinks
ChatGPT.
with Raoul and Andreas getting shit-faced. There's nothing else to do.
Exactly. Um, let's see whether people will pay for that, but hopefully so, right? But joking aside, Raoul, the point here is that in 5 years' time, an entity will be one person most often, I think, or two persons. We will have much fewer companies with a lot of employees because you're essentially able to set up a company and get a lot of stuff fixed via AI instead of having an accountant and having a lawyer and all of that. To some extent, right? I'm just trying to think ahead here. That's a big productivity boost because I can be a lawyer, I can be an accountant, at least if it's not too complex, right? And if productivity grows at a much, much faster pace, it's actually possible that GDP on a trend basis starts growing a lot faster than what we've been used to since '08. And that could alter the picture a little bit in terms of debt to GDP. What I don't know, and I'm curious to hear whether you have thoughts on that, is what happens to the workforce in this environment? Will we have to ultimately pay 50% of the workforce some sort of universal basic income? Or what will happen here? Or will we end up as solo entrepreneurs, all of us? Or
My view on this is yes to both of those, and also that we will adapt and find new ways. And you've said it, is entertaining each other, i.e. being humans. The humanistic things, whether it's music, that can be done by AI, but to be live on tour can't be. To be at a restaurant is valuable. To be on holiday is valuable. To be at a live event where you're meeting other people is valuable. To be communicating with people and just being a human, whatever that means. So I think that's where, and David Mattin talks a lot about this, is like, we're just going to have to lean into being human because that's the only thing the AI can't be. The AI can't come into a room, give you a hug, say, how you doing? Let's have a drink, whatever. It can't do that. And that's a very human thing. So I just think we do adapt over time. The question is where do the revenues come from for the state? How do you tax AI? How do you tax, because a lot of this can be just agents. How do you tax them? How do you tax the robots? How do you bring the income side in to pay the UBI on the other side? That's not sure. While GDP growth could be 10% because of the insaneness of the productivity boost that happens. So you're getting massive GDP accruing to whom? Not clear. It's not large corporations employing 30,000 people. So, how the fuck does distribution of wealth happen? Does it matter anymore? I don't know. And this is why I came up with this idea of the economic singularity, where it becomes so much of I don't know anymore that I just think I just don't want to be trying to make a living in 6, 7 years' time. I want to have made my living so I can observe it and not have to adapt. Young kids will adapt. But, even for you and I, 7 years' time, unlikely to adapt to the scale of what needs to happen. And so I just think we'd better be careful. Now, coming back into the current day, the pushback or the fears that everybody expresses are tariffs, it's the end of the global system, everything's going to break, it's recession, it's inflation. What is your mental framework for tariffs? What are they trying to do? Why? And what will be the likely outcomes?
So, at least for now, Raoul, it looks to me like they're actually expecting to get some revenue out of these tariffs.
That's right.
And that's a newcomer in a sense, because initially I thought that reciprocal tariffs would lead to some sort of race to the bottom, and the whole purpose of it would be to, create a race to the bottom. Because if you add reciprocal tariffs on Indian exports, they would have to get rid of their very, very high tariffs on US imports, right? But as of now, it doesn't really look like that's the game plan. So I have to accept that I need to change my thesis a little bit here. And what we do know, Raoul, is that even though we ultimately end up only entertaining each other in the future, we'll still have to eat food that crosses a border. And I actually think it's a decent revenue source for the government to tax that banana moving from Nicaragua to
Yeah, I mean,
US.
I live in the Cayman Islands. We don't have taxes, but we have import duties, which are tariffs.
Yes.
The whole country here works on a 30% import duty-ish, depending what it is. Between, books might be 0 and cars are 30%. But, everything you pay on import duty, it's all a tariff.
Yes. And, most of the so-called tax havens, they're orchestrated exactly as you mentioned here. Yeah. And the more digitized the economy becomes, the more important it will be to tax the few physical goods left. And, that's kind of why I'm...
Or you tax consumption of stuff.
Yes.
Because it's easier to capture, like VAT is very easy to capture versus capital gains tax and all the other more complicated things.
Yeah. And, let's see when we end up driving in robo-taxis and all of that. But to give you a piece of anecdotal evidence from Denmark, we tax cars. The VAT on cars was 180% when I bought my car. But you need a freaking car, right? So it's a very, very efficient way of taxing people. And it will become, on a relative basis, even more efficient as the economy becomes more and more digitized, because it's so difficult to tax digitization, basically.
And arguably, here in the Cayman Islands, it's so much easier not having to file tax returns, company accounts, capital gains tax, inheritance tax, any of these things, but you pay it through a eye-wateringly expensive supermarket or whatever you're bringing in, but that's based on consumption. So it's difficult for super low-income people, workers, but there's abilities for them to get supported. But beyond that, it does seem to work.
Yeah. And coming back to the inflation question based on this, right now, live observations do not point in the direction of high inflation, rather the opposite, which is a huge contrarian call of mine right now. That's Everyone I talk to is in camp inflation.
Yeah.
And it seems so obvious that when you increase input prices on goods coming from outside of your borders, that prices will have to increase. But you need to look at the side effects of all of this. And we have plenty of observations now of falling service prices amidst all of this. So sure, the goods side of the equation will likely be impacted by these input costs when you import stuff, but the service prices will drop. And, I think that will accelerate over the next 3, 4, 5 years. So, ultimately, I guess you should expect to pay a lot more for groceries, but the rest will essentially be almost free. And that's...
Well, just going back to the conversation we were having before, right now, most people are starting to pass legal contracts through ChatGPT and then only going to the lawyer for the last parts. Think how much that saves you, the $500 an hour for lawyer time, and you fuck around with ChatGPT, you get it into a certain shape, you backwards and forwards, then you go to your lawyer, it costs you $500 as opposed to $2,500. That's so deflationary.
Yes. And it's the same thing happening across the board, basically, in services. And, you're absolutely right. The last 3, 4, 5 times I needed a lawyer or an accountant or something like that, I did 80% of the work myself.
That's right.
Yeah.
Then you only have to pay for the stamp and yes, this is correct.
Yes.
And I'll put my signature to it.
Yeah. And as you say, it's deflation. It's not disinflation. It's deflation. It's falling prices, right? When you measure it as a consumer basket, because my consumer basket included spending on lawyers, accountants, all of that up until now. It's still included, but it's just a less and less and less important part of the consumer basket, meaning that my consumer basket drops in price, essentially.
Exactly right. So the other thing is that, look, everywhere's got tariffs around the world. This is not new. The US is just kind of elbowing its way in, saying, hey, we want to get some equalization of tariffs too, please. Okay, fine. Nowhere else is everyone saying, oh my God, Japan's got tariffs, it's inflation.
Yep.
And Trump's last tariff round, CPI fell.
Yeah.
Core CPI fell, and CPI was 1.9% over his entire term.
Yeah. So, ultimately what we're saying here, Raoul, is that the tariffs they're likely here to stay to some extent.
Yeah.
The exact levels, I don't know, and whether there will be carved out some deals here and there. But overall, the whole notion that the US will have to take in some taxes from the rest of the world, I think that notion will stay in place. That's the overwhelming signal that we get from the administration now.
And my guess is in 6 months' time, we won't even be talking about it.
Probably
it's just
not.
Everyone's like, the world's going to go into recession. This is the most ridiculous thing. We're like, well, tariffs have been going for centuries. It's an Arabic word. I don't know. It came from probably 2,000 years ago or 1,000 years ago. And so I just don't think it's that big a deal.
No, of course there's a short-term shock here, but that's it, right?
And doesn't that short-term shock get the central bank? Because we've both been talking about a soft patch in Q1, which is very clear, might drag a bit into Q2. That puts the probability of the central bank coming in higher, which is what they needed anyway.
Yes. Let me put forward my working thesis on why Q2 will look soft, but artificially soft. If you look at, for example, truck miles in the US through Q1, if you look at trade statistics, etc., everyone taking decisions based on what they read in the media, they've obviously imported stuff ahead of these deadlines, right? And they made sure that everything needed in their supply chain made it to the US before they had to pay this import tax, right? And therefore we have, artificially large imports through all of the first quarter in the US. That's also why these GDP now models from the Federal Reserve System look abysmal. It's because of a net import. It's a technicality, and I don't even want to bother you with why you measure GDP like that. But ultimately, it just means that imports were brought forward. Then in the second quarter, we'll have less imports because of that front running of tariffs. And then the net export will suddenly look artificially strong, and the GDP models will look amazing by June. But has something really, has the trajectory changed here? No, you've just moved some stuff into Q1.
Yeah, you've not
you've
not changed trend rate of GDP growth. You've just got GDP calculation lags, essentially.
Yes. Yeah. So, this is more of an accounting discussion rather than a discussion on actual activity levels.
Although growth is slower in Q1.
Sure, it is. And probably due to the sentiment shock of all of these headlines. And
I think, from my view, it was also the strengthening of the dollar and the raising of rates in Q4 2024 feeds through that lag, and it slows down the economy somewhat.
Yeah. So in a sense, Trump has, in a way, artificially nuked the business cycle very short term here with these tariffs. But everything that you typically use to forecast the business cycle provides an improving signal compared to before the tariffs were implemented. So lower oil prices, a weaker dollar, lower mortgage bond yields, so on and so forth. The stuff that you use to forecast all points in the same direction of some sort of positive squeeze in the economy once it feeds through. So, I don't know whether the administration, or I don't know whether Trump is aware of this. I know Scott Bessent is aware of this. So I think even Scott Bessent Stephen Moran, those guys, they'll allow this to play out because they know what will eventually happen 6-9 months down the road due to the market
Because they
effects of
can
this.
say, because if you know the liquidity game and the financial conditions game, you kind of know when financial markets and the economy is going to go. So you can claim a victory. We did this taxing, and now look at our economy. It's growing at 3.5%, and markets are up. From that shock, they're up 30%, and everyone's like, "That's amazing." And that's the game, right? Because that's what the forward-looking indicators suggest. Is like growth is going to be hot in the back end of the year, and markets should be strong all the way forwards.
Yeah, and that's why it's a very, very common take from political pundits in Europe right now to say that Trump will be slaughtered in the midterms, and everyone doing business cycle forecasting will know that the opposite will happen, because they will actually orchestrate some sort of positive business cycle development into 2026, and people will not remember that he pissed them off this year by the time they'll have to vote. That would be my guess.
And I think they know that game. I think it's a game well understood. Anybody who's been in markets for a while understands how this works, and understands the cyclicality. And normally 2026 will be a slowdown year, but it looks like they're trying to push the liquidity, financial conditions further out, which will get it closer to the election time as the stimulus starts coming out of the economy.
Yeah, but ultimately, Raoul, the flip side to this discussion is the whole notion that manufacturing jobs should be brought back to the US. I don't really think that's feasible.
Well, have you seen those memes going around of Americans sitting in factories sewing stuff? It's hilarious because that's never fucking going to happen.
Yeah.
When the factories come back, they are Tesla factories. What does Tesla factories have? Very few humans and a lot of robots and AI.
Yes.
No jobs. The construction sector will do well.
Yeah, that's true. But you're right. It's not a feasible medium-term view to expect American workers to make Nikes, right?
They're just never going to do it. They're never going to create Nike factories with people hand stitching Nikes for $3 an hour. It's just never going to fucking happen. It's just going to be 3D printing of Nikes and 2 supervisors. Yes. And people don't realize that. So it's a bullshit political line of what he's telling people. It's not that at all. It's actually all about the robots and AI and onshoring it.
But Raoul, let me test this thesis with you then, because if it's bullshit, and I agree, we're not going to bring back those manufacturing jobs to the West. Instead, we're going to tariff the goods coming from Vietnam to the US, or bring back factories via automation, right? And you're going to, at some point, hand out those exact tariff dollars to those workers not working in the Nike factories via some sort of universal basic income, I think, or direct transfers, you name it. I think that's what's going to happen to some extent.
Well, it's even been raised because they kind of said they would think about giving a tax, whether it's a tax incentive or financial payments, to the bottom 50%. I talked about it in the Cayman Islands. It's hard. The import duty thing is hard on people of lower incomes. So you take in tax, you give them money back. The wealthier of the middle classes pay based on their consumption, essentially, of goods. And you can do that for a while. And that, by giving money to poorer people, stimulates the economy because they spend on TV sets and Walmart.
Yeah. And at least according to the latest statistics, I guess almost 50% of consumption is driven by, those with high incomes or high wealth, at least, which was quite surprising to me. I saw those statistics the other week. So sure, you're absolutely right that this is hard on people with lower incomes, but I also think that there's, a feasible claim here that you're actually taxing those with medium to high incomes pretty efficiently via tariffs.
So, okay, so we've talked a lot about the US. We think it's ongoing stimulus. We think the tariff thing is somewhat of a red herring. It's a shock that gets readjusted over time and it becomes the norm and people stop talking about it. There may be something to do with taxation that helps some people in this equation. You don't think it's inflationary. You don't think it's a recessionary either. Talk to me about Europe. I just want to cover Europe and China a little bit because they're somewhat different in what they're trying to do and how they do it.
Okay, so first of all, let me just nuke the notion that Europe will do well if the US does not do well. I mean, that idea was brought forward by quite a few people during the first couple of months of the year since we saw that outperform.
I've heard this so many times in the past. Europe will decouple. I was like, no, a weaker dollar means some of the European assets do okay.
Yeah,
but it doesn't decouple. Nothing can.
No. It was more like it was a cyclical trade, right? To be long Europe, and over the past 3-4 weeks, it hasn't really worked. So that notion was just bullshit. The only thing that I'd like to discuss with you in relation to Europe is that when I look at European technology stocks, they've always traded with a premium to U.S. technology stocks. Actually, I consider European technology stocks expensive because all PMs in Europe we want to be able to buy some technology here, right? But we cannot really. So the few things that are here, we're willing to pay more for that for some reason, right? In PE terms, they always trade expensive. But I don't know whether I would be super happy with the current tariff situation if I were part of the C-level in one of the Max 7s, because I think at least the cloud business, I think there's a case for the Europeans to try and move that back home.
So that's more security.
Yeah. Take the German administration, take the Danish administration, take the Spanish administration, take the French administration. They're all hosting their stuff with one of the Max 7s, typically Microsoft Azure. And at least for now, the trend is moving in the opposite direction. Is there a feasible path to bring some of that infrastructure home? The servers are already here, right?
Difference to the gas industry. It's like if you've got critical infrastructure that is from outside of your borders, you need to be very careful. And so it kind of makes sense. It's like Russian gas versus US data storage. I get it.
Yeah. And it's been a tremendous bet so far. It's one of the stocks that I've highlighted in our pro macro tier, but the French OVH group, they're probably the only company right now with, a decent position to take some market share here based on that digital infrastructure security story. And I actually think there's some merit to that, given what's ongoing. So yeah, we'll find small pockets of strength.
Will
here.
the Europeans stimulate? Are they going to for their defense spending or to offset tariffs? Because we're waiting for the Europeans to do something, whether it's increase the use of or stop shrinking their balance sheet or start to increase M2 via other measures.
Yeah.
What are your thoughts?
They'll have to, because I mean, take a look at the promises made by the new German administration. We're talking issuance in a size that we haven't seen outside of world wars, basically, from the German administration. And given how German bonds traded during the second half of last year, we already got the early warning signals that the balance sheet of the ECB is not large enough to support this issuance of European bonds at the pace that we're going to see in 25, 26. What I'm still skeptical about is whether you get countries like Italy, Spain, Portugal to issue bonds to buy tanks. Take a look at their defense spending. It's non-existent. They're a handful of borders away from Russia. They couldn't care less. And, that is the honest answer to that. Take a look at surveys conducted among the population in those countries. I love Italy, Portugal, and Spain, but they couldn't care less about the Ukraine war. It's too far away.
So, okay, so Europe growth slows down. The ECB cut more. There's a bit of the stimulus to come because they've got to manage the debt like everybody else. China's more awkward. I've got a thesis on China. Other people have got thesis. What's your China thesis and what they're going to have to do?
So I think China will allow the companies exporting to the US to try and carve out some deals with the US. Because at least if you look at the direct export from China to the US, we're talking 2.5% of GDP. Of course, that does not account for all of the rerouting that happens, right? Take a look at the trade statistics between China and Mexico after the first round of tariffs, right? If you don't implement tariffs on a global scale,
which is what they're doing this time. They've even talked about it. I think it was Besson talking about the arbitrage, which is why they're like putting tariffs on like the Marshall Islands and stuff like that. It's like you're not going to reroute your shit through somewhere else.
No, but if this tariffs regime is more permanent in nature, as we basically concluded just a short while ago, Raoul, China will have to alter their strategy because they've been a manufacturing hub and they've exported to the Western consumer via Vietnam, Mexico, etc. for a while. So they will have to come up with ways to prop up the local consumption. And they cannot do that with the dollar trading as strong as it is right now versus the Chinese yuan. As we speak, the dollar is making new all-time highs versus the Chinese currency. So that is what they will have to ask for.
And that's my view, but it's interesting to see Arthur Hayes yesterday saying, oh no, they're going to devalue their currency. I'm like, they can't. They bankrupt their entire property sector because it has dollar debts. 50% of Chinese debts are dollars.
And that is exactly why they're not going to sell their treasuries, because that would lead to an upwards pressure on the dollar versus the Chinese currency, exactly what they do not need. So I think they will ultimately accept, and that's why they're not budging right now. They'll accept that tariffs are permanently high against them. But in return for the US administration not escalating, they'll end up deciding to buy some more treasuries in return for some dollar liquidity deal. Basically some sort of that's basically some sort of light Mar-a-Lago accord. I think that's where it will end up when the tariff regime is fierce enough for them to get to the table.
Because they have to stimulate. Their bond market's telling you that. Bond yields have been in free fall because there's a debt deflation going on in China. They need dollars and they need to stimulate. So, because they've got issuance going on. So it just feels like there's a grand bargain to be met. And it surprised me that people think that they want to devalue their currency. They don't want to do that because that just encourages capital flight out of China and makes it ugly.
Yeah. If they do that, it's not my base case, but if they do that, watch Bitcoin and gold and the likes, right? It's another debasement bet in case. So basically just underscores the point.
So let's talk about asset allocation then. In the next, let's do time horizon because if not, everybody gets confused. Let's talk about short-term time horizon, shorter term, like over the next couple of months, and then, where is your kind of structural view over the next year, what you want to own?
Yeah. So, my working thesis right now is that I'd like to see the liquidity conditions deteriorate enough for the Federal Reserve to have a perfect excuse to get involved.
And you're talking here about kind of plumbing liquidity.
Yes. And I think we're getting there, right? With the markets that we've seen over the past weeks. So as soon as you see early signs of the Federal Reserve getting involved in this, it's basically your clue to reload on risk. Until we see that, and that's what I've done here. I'm short commodities and long bonds. I think risk reward is okay being long bonds here. And now we're talking very, very, the part that I tactically manage. And it's been okay for me over the past months to take that view. Looking 12 months ahead, I would put a very, very high probability on some sort of global coordinated liquidity response to what's ongoing. And we kind of know the drill when that happens. All of the debasement bets will be back in fashion as soon as we see the M2 going up on a global scale. We're basically already seeing it, actually. The early signs of it are there. It will probably not be, if they do not coordinate in a coordinated fashion add liquidity, it will not be the huge bull market that we're all hoping for, but it will still be a bull market, given what we know already now.
Now, over the last few years, you've gone from not being a crypto person to putting crypto as just a macro asset like everything else. What was that? What was that journey? Why did you do that? What made you change your mind?
Well, watching people buying Lambos all around me. No, I'm just kidding. But this guy as well. We called him Thor. And I grew up with this guy. He made a killing in crypto. And growing up alongside him, seeing him being much earlier on this thesis than me, obviously made me think. And back in 2020, when I finally capitulated and accepted that it was a transparent coordination between the Treasury and the Federal Reserve, and the Treasuries and the central banks globally, I think that was kind of where I capitulated and said, okay, this is what's going to happen from here, because it's not even hidden anymore. And therefore, it took me too long, I'd say, to recognize that it was here to stay. And the Silicon Valley Bank case was the final nail in the coffin. I remember you and I doing an emergency live, probably on the week after the Silicon Valley case, and you basically just leaned back and said they're going to, just going to backstop this. And having worked in banks and cooperated with bank treasuries, I was scared of that because, it was the first thing I saw when I entered the trading desk. It was Lehman, and it wasn't backstopped, right? This felt Lehman-like when I, immediately when I saw I kind of got that PTSD from the Lehman crisis. And I told people that this is Lehman-like if they don't do anything. But they backstopped it, and they backstopped it immediately. And the defining moment for me was this. I think I can't remember his name, but a senator from Oklahoma asked Janet Yellen in Congress, maybe the week after Silicon Valley Bank, okay, if this was one of the community banks in Oklahoma, would you backstop that bank as well? Would you backstop my voters' deposits in such case? And she didn't give a clear answer. And that led to this whole deposit flight from regional banks into larger banks. Ultimately, the Federal Reserve and the Treasury Secretary basically more or less publicly stated, okay, we're also going to backstop the regional banks as a consequence. So the system is now backstopped officially. That was where I caved in, finally. So I made a lot of money on crypto, especially MicroStrategy in 2024 for tax reasons. I had the biggest position in that. But I'm here to stay now.
Because you realize that is the fastest horse to back in a debasement.
Yes. The system is backstopped. That was what I learned from Silicon Valley Bank and the regional bank crisis. But it took me too long to acknowledge that everything is backstopped, because it essentially is.
And so tactically, you'll have bets where you're long bonds, short commodities. Structurally, because of your debasement thesis, liquidity thesis, you're going to be wanting to be long duration assets, crypto, tech, that kind of stuff as a general trade, I guess.
Yeah.
As a structural book.
But I prefer crypto to the Max 7s here, due to the discussions we had on IT infrastructure, security concerns from Europe, and all of that. So if I should pick between the two, I would certainly lean towards crypto.
You don't tariff crypto.
No, how?
Exactly.
So I think that's a valid point here, that tariffs will impact Max 7 more than crypto ultimately. Let's see whether we get that big disconnect between crypto and the Max 7s. I sincerely hope so over the coming years. And I think that's basically my main takeaway. What I've struggled with historically, and that's something that I've had to, for good and for bad, teach myself through a couple of drawdowns, is to just not look at it when it looks like this. My crypto holdings.
I don't even look at it. I don't look at P&L.
Yep. I use Kraken, and I haven't been logged into Kraken since mid-January.
Yeah.
And I sincerely mean it.
Yeah, no, I'm the same. I don't look at it.
I haven't told my wife about how the developments are either, because then I would be under pressure, right? So, that's...
But we're all learning how to have longer duration in a high volatility asset, right? It's not something we learned. You, as a money manager, because you run a hedge fund as well, you can't do that. It's not a mandate for anybody.
No.
But the volatility is what drives the returns.
Yes. And here's the main takeaway, Raoul, because, I've been running a hedge fund through this mess. And in a hedge fund, you're not allowed to make large drawdowns on behalf of your clients. So you need to watch it. And what's very difficult is to watch something that trades against you and not do something. The human mind cannot stand watching that. So if you have if you run your own money and you're allowed to make drawdowns on behalf of yourself, right? No one cares outside of yourself. And if your time horizon allows for a drawdown, don't watch it, because you cannot stand watching it. So just
how I deal with that is that obviously I watch it like a hawk. I've got hourly charts of crypto and tech and whatever, but I don't look at my P&L.
Yeah. Okay.
So I can be involved in the market and the hopes and dreams and the fears and the horror and all of that stuff as a market, but I don't look at my P&L, because if not, you connect the two and it's like, holy shit, because your P&L moves around a lot.
Yeah, it does. It really does. So I'm involved in a couple of coins with pretty decent size, and that's something I just intend on not looking at. Then obviously, as you always allude to, Raoul, make sure that you take lifestyle chips off the table. I've also done that late last year. I aced that MicroStrategy trade and never reinvested it.
But how do you manage, because you're running a portfolio which is higher turnover, which is the fund? You've got one mindset for that.
Yeah.
How do you deal with the dual mindset?
So in the fund, I allow nowcasting to take most of my decisions, right? Because it's actually very tricky when you have to trade and when you have to navigate drawdowns. It's very tricky to not get emotionally involved in that on a running basis. So I prefer some sort of system-based setup. Yes. So I now cast inflation, I now cast growth, I now cast liquidity conditions, and it will provide me with a signal on whether to lean bullish or bearish, very, 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 very near term. And that model framework is what I use to take short-term decisions. That framework will not tell you anything about what happens in 3 months from now. Nothing. It just tells you something about the present. And when you manage risk with, drawdown considerations, you have to stay in the present. While if you manage your own portfolio with a larger risk appetite and with a larger appetite for volatility, you need to look at the business cycle and look ahead, right?
Yeah, you have to live in the
too
future with these assets,
yeah,
and the present with a real-time P&L for clients.
Yes. But to be honest, it's been tricky to navigate those two time horizons for me this year.
Really hard. Very few people can do it. Stan Druckenmiller is one of the people who can do both.
Yeah.
It's a really hard skill set. I can't do both. I just can't do it.
Yeah. But the only reason why I've managed to is that I haven't looked at my own holdings.
And you've
Yeah.
taken the emotion out of the other side. You
Yes.
still have the emotion of how you're delivering for clients and all of that.
Sure.
The emotional decision making, the trigger pulling, a lot of that is taken away. So, and then you've removed the emotion of the long duration assets by not looking at them.
Yeah.
And saying, if the business cycle plays out, I'm using my business cycle liquidity framework, and that takes me out till end of the year or whatever.
Yes.
In which case you can say, I shouldn't be looking at it.
Yeah.
Makes sense.
So that's kind of it. And it sounds easier said than done, right? But
always is, my friend.
Yeah.
So let's see how this all blows over. This is Tuesday, 8th of April. You think the low is in markets?
I've said yes to that question once over the past week already, which proved to be wrong. So my best guess right now, and I actually said that in my last State of the Union, is that in between the 15th and the 30th of April, we'll get the low. So we'll have to
1 month time.
Yeah.
Prices are higher.
Yeah. And the reason why I say so is that we actually still have that capital gains tax season upcoming because of returns from last year. And that's between now and the end of the month. We typically get some vol around that. And then we obviously don't know whether it will escalate a little bit between China and the US. But if you look at financial conditions, and especially the way that the dollar impacts, for example, Bitcoin, May is the final chance to get involved on the long side again, in my opinion.
Yeah, I'm the same. I think it's bottomed, but we'll see. But it's in this window. It's in this very short window between now and 2 weeks. It's the last chance saloon, I think. And I think you've been given a gift in a lot of this stuff, because if we're both right that liquidity will accelerate, the forward-looking stuff is already lots of liquidity coming, or will affect asset classes. But if it keeps going, then we got to. Yeah, this was the last big dip to get to leverage into. Good, my friend. Great to see you as ever. And, for more people to find you on Real Vision Pro, you and I have these discussions on a monthly basis. You deliver your State of the Union. I deliver stuff. You're delivering research reports. There's a whole ton of stuff there. And it's not like we always agree. It's not like we're always swapping notes. Sometimes we'll disagree. And the value is in all of that. And I always appreciate just spending time with you and chatting about this stuff.
Yeah, and thanks very much for having me, Raoul. One thing I'll say before I leave you, is that I promised to open an OnlyFans account if Eurodollar traded below parity. We're now far from that level, and I even promised to label that OnlyFans account macro meets micro. No more comments. But I think because it's actually something that we've received great feedback on. I love picking out micro cases in Europe, in Asia, in the US. For example, this OVH group stock in France. So I've been pondering whether to add like a monthly or a quarterly piece called Macro Meets Micro, where I use my macro framework to find micro cases. Yeah.
Interesting stock picks or whatever they are. Yeah, it's a nice idea. Love it. All right, my friend. Well, good to see you, and I'll see you on Real Vision Pro soon.
Yeah.
So, as promised, great conversation. Andreas really is a great mind in this space, and I love bouncing ideas backwards and forwards with him. Just our realization that tariffs are probably here to stay, and it's a change of the structure of markets, but maybe it doesn't matter over the longer run, that this is a short-term shock. I have been very bullish into this, thinking that this low that we're seeing in markets right now is really a big opportunity, and Andreas is coming round to that as well. So we've got a bit of a timing gap still, which is great to know. So you guys can see, okay, Raoul's bullish now, Andreas, give it another week, give it another month, that kind of thing. When we all come together is when signals are really great. And it's the nuance of understanding and discussion that makes Real Vision Pro Macro so powerful. And in Pro Macro, you get to actually ask us questions too. That's the difference. You get to say, hey, what do you mean by that? And what are you thinking about that? But anyway, hopefully it gave you a bit of the magic. I'll see you next time.
SuperAI, Everybody wants to know what's going on in AI. This has been the event to figure it out. You get to speak to the smartest people like you trying to figure this out, but also the people on stage. They're the experts. So we get all of that, all in one place, in Singapore. What more can you ask? It's a brilliant, brilliant event, and you'll come away with lots of new ideas and a better understanding of this incredible exponential world.
Hey, thanks for sticking around to the end. Look, if you enjoyed it, hit the subscribe button and check out the video here on the right-hand side. I'm sure you'll enjoy that one as well. And if you're ready for more, go to realvision.com/join. I'll see you there.